Welcome, everybody. This is Capita's quarterly market recap, quarterly market insights. We've partnered with Townsquare. Townsquare is our investment platform. They're a boutique. They call it turnkey asset management platform. Kurt Brown is the chief investment officer and president of Townsquare. So he and I have done this several times. You should be pretty familiar with Kurt's enthusiasm, excitement, and ability to explain complex markets in a way that most of us normal people can follow, which is wonderful. Today, this episode, I call it an episode because I'm so used to the podcast, but this webinar will be an episode probably on the Financial Call podcast, as well as we throw it up on YouTube. The recording will be available on our websites, and just ask anyone at Capita for how to get that, but you should be able to find it on thefinancialcall.com. And there's a little button in the top right for free resources, client webinars. So that would work pretty well. We'll have visuals throughout. And Kurt, what I think I'd like to do is just show a little bit about some of the research that I was doing for our quarterly market recap. And then we'll turn it over to you and we'll dive right into what you have planned. Sound okay?
It sounds good. And I was doing a little stalking on Twitter, and I saw some of the stuff you've been working on. So I brought some data to add to your data.
Perfect. Actually. Perfect. That's great. Kurt and I each follow each other. We have very few followers, but we follow each other on Twitter. Okay, this will be good. First of all, man, I don't know what it is about the last week or so, but just thinking about this whole last year, I have been so grateful. I know that there has been a lot of hardship for a lot of people, and especially of many of our clients that are in the healthcare profession, that it has been absolutely insane for you. There have been so many silver linings. You know, the time spent with people, the closest people in your family, being stuck together sometimes it was a really, really good thing. And I hope that all of you are doing well. I hope you're healthy. I hope you're safe. I hope we can see 2021 provide us with some vaccines and a path forward. But I am absolutely grateful. It has been wonderful to get to know all of the clients all of Capita. We consider you our Capita family better and better. I just want to express, I hope that it's not lost on us, the fact that you all look to us for financial advice and guidance, and that opportunity to be able to give that knowledge. One, we like it because we nerd out on it, but two, when we can see that it improves your lives, it's a big deal to us. So thanks for listening today. Thanks for those who are listening later. I'm going to jump right in. This document you're looking at, we will send this out. I do this quarterly. It's had a slightly different format. Capita's rebranded and new logos and colors and everything, and we're excited about that. But anyway, just to give you a quick feel, this is what it looks like every quarter. We send this out. I do a little write-up, teach you a little bit about what's going on, how to look at markets, how to think about things in general, and then on the right side, give you a quick recap on U.S. equities, foreign equities, and fixed income. But instead of showing you this sheet, I'm actually going to take you right to the source. So here it is. Basically, we went through all approximately 2,500 trading days in the last decade and figured out how far off the all-time high of that moment. So at that moment, there was an all-time high of the S&P 500. How far away were we from that S&P 500 all-time high? So when you look at it, for example, on Christmas Eve, we were only 0.5% below the all-time high of that time. And if you go back down further, you'll start to see that it gets red here as we get back into March. That was the bottom of this year. So on March 23rd, we're down 33.93% off the all-time high. So then what I said was, let's just chart that out. So as you look at this chart at the top, this orange chart, every bar represents a trading day. And however far below the zero line, that's how far off that day ended from the all-time high of that moment. So the fascinating thing comes when we start to play with what I call a band. So in other words, I'm just going to uncover this here for a second and say, let's say you wanted to know how many days ended within 1% of the all-time high at that moment. Out of all 2,500 days, 40%. This is just shocking to me. I was anticipating, as this is one of those projects that you start to run the numbers and you kind of have in your mind the number that you think you're going to see, and then you run the project and you get a number and you're like, this is for sure wrong. I got to rerun the math. So then you go back through your formulas and you think I did something wrong, and you double check everything and you got it right in the math, and then you rerun the numbers again. So 40%, if the number, so of course I played with it and I said, well, what about half the time? What number would you have to get to be half of the time within that band of that close to the all-time high? In other words, half of all trading days in the last decade have ended within 1.65% of the then all-time high. And then if I push this out to 5%, we're talking about over 3/4 of days. You see the blue is now covering up these orange bars. Every orange bar it covers up counts towards that 77%. And if I take this up to 9%, we're now talking about 90% of all trading days in the last decade ended within 9% of the all-time high. So how do you take this information and use it? Well, we've had a lot of calls and a lot of people who are very nervous, rightfully so. We have different markets than we've ever seen before, right? The funny thing is we always have different markets than we've ever seen before. It will always be different, and next year will be different than anything we've seen before. So that statement's just the way it is. But we get a lot of calls from folks, and either they're thinking, I want to get more conservative, or I want to wait to invest. And that is tough, especially if you're like, we're only 5% off the all-time high. How can I invest at this point? Well, we spent 3/4 of the last decade 5% away from the all-time high. And if you have to find the right mix for you. I really don't want you to think I'm saying be aggressive, because that's not what I'm saying here. But what I'm saying is, if you're in the right mix for your situation, don't let the fact that we're near an all-time high throughout any period of time scare you away from being in the right portfolio. That is the lesson to walk away with today. Let me show you in that little write-up 3 stories here real quick. In March of 2017, I was talking to a client, and they had about 30-ish% of their portfolio in stocks. Pretty nervous client, concerned about going any more aggressive than that. That's too conservative for their financial situation, their time, and their needs. But I respected that, and they basically said, you know what? If the S&P drops to 2100, we'll bump that up to 50, 60% in stocks. The S&P 500 is currently at 3768, and it never hit 2100. So this client wanted to get that opportunity with it when it drops down to 2100 to go more aggressive or go to the right portfolio basically for that person. It ran away from them and never happened. In April of last year, I had a client say, I want to get more aggressive if the S&P 500 drops below 2256. That never happened. Again, we're at 3768. And then just in November of last year, I have another one who has a Roth IRA that is thinking, I'd like to go a little more aggressive in just that account if it drops below 30 or 3025. Now, we might get that. That's 750 points below where we are today. I mean, 2100, we might hit that, right? We can't promise anything with markets. But the point I'm trying to make here is emotions are not great in this investing world. I'm belaboring this, so I'm going to end it. But it was just a fascinating experiment that caught me off guard, and it also helped demonstrate what emotions do to us in investing, and it also helped demonstrate that markets tend to be positive long term. Now, I'm going to throw out a disclaimer here. If I had included the decade prior, we spent multiple years in a low, quite a bit off the high from 2000 and early mid 2008 to about 2010. So there would have been 2 years out of that decade where we were pretty far off the all-time high. But after that, it's been gangbusters forward ever since. Kurt, anything on this before we dive forward into your stuff that you would comment on or think about?
Yeah. So I read your post on Twitter because, we've got 5 followers or whatever each we have. And I thought to myself what you just said. I thought, okay, I'm loving Zacc's research. I was surprised as well. I couldn't believe how tight the last decade has been, pinned near the highs. But my thought was 08 is now more than 10 years past. And so I thought the last decade is very rare to have this much gain in equity markets and not have really ugly bear markets anywhere, because we had one in '08, we had one in '02. So I decided to go back further, and I went 70 years back.
Oh, wonderful. Count
So
on Kurt to just take it all the way. Go for it. This is amazing.
So I loved it. And I saw that you teased that we were going to talk about this today. So I thought I'd go get the data. So I won't go into it a whole lot more, but I give you a little bit more ammo.
Wonderful.
So since 1950, there are 9 major bear markets, big ones. And even with that, the S&P 500 has spent a third of every day within 5% of its all-time high. Even with the 70s and 80s inflation and recessions, the dot-com meltdown, '08, COVID, everything is in there, man. This is the kitchen sink. So, but there's some other things about the market being high. It's the reverse of what we think. Strength actually begets strength. A strong economy typically begets more strong economy, right? When you think about the math of economic expansion, it feeds on itself. It adds wealth. It drags up the lower classes. There's a lot of tailwinds that come with strong economies. So the market actually should do better, right? Strength begets strength. And that it's weird for us to think that. But here's some other data that I found after we kind of parsed out the data, okay? 82% of the days when the market makes a new high, and on Zacc's chart, that's when that column said 0. It's no percent below the all-time high, right? 82% of those days, the market's higher 6 months later. 82% chance. So if you get up in the morning and you hear someone on the news say, hey, the market made a new all-time high yesterday, there's an 82% chance the market's going to be higher in 6 months. That's incredible. And then number 3 there, since 1950, when the S&P's been up 30% in a year, a 30% year, right? The market was up the next year an average of 15 again, right? So, and then we found a couple studies that were a little bit further back. The market's actually been up. Then, by the way, Zacc, here's trivia. I'm going to put you on the spot. You go back 70 years, roughly how much is the S&P 500 up annually for 70 years? Just ballpark.
Ooh, if we're going 70, I'm going to guess 11 and a half.
Yeah, it's like 11. Okay. So for 70 years, you make an average of 11% a year, right? How many years is the market actually up 7 to 12%? Almost none. There's only 5 occurrences in 70 years that the market's in with even a 5% band of the average. But the market's been up 18 times over 30%. So the returns in stocks are extremely lumpy. And you can go years upon years with the gains in equity markets. It's actually just historically totally normal. And then going back since 1928, when any day that the market makes a new all-time high for 1 year, the next year, almost a 15% gain. So the point is, we shouldn't, when we hear the market just made a new all-time high, we should actually feel enthusiastic. But what we should really be talking about is the fundamentals of the economy, right? And so the larger discussion, Zacc, if there's a segue in this, is that the problem we're all having is that we are looking at millions of unemployed people because of COVID and the market making a new all-time high. This is the problem, right? The number one question I get is, how on earth can the market make a new high when large portions of our economy are shut down and the federal government is printing money like there's no tomorrow? This really is what's boggling most people's minds right now, right?
Yeah, and it feels fake to a lot of people, right?
Oh, yeah.
They hear and it feels, and it is fake to a certain degree, right? I mean, there's a certain amount of stimulus which is not natural economic activity, and that's concerning for sure. So you're right, and this is where you shine. And so I assume we'll move right into basically what do the fundamentals of the market look like from this point, right?
And let's talk about it. So I want to start where I usually end, which is the working checklist of our investment committee. We meet every week. We argue all the time. They're very spirited meetings. It's a good thing they aren't recorded. And when you have a bunch of type A people in a room, you're going to get a lot of different opinions, right? But this is basically our working checklist of what we like and what we don't like, right? The stimulus, I'm going to talk a lot about cash. Cash is going to be a major driver and theme. Interest rates near zero. Literally, in the history of lended money, we have never had interest rates where they are. They are the lowest in 5,000 years. Borrowing money is almost free. And that changes the rules that you and me learned in business school. It changes the cost of capital, which is a big deal. Household balance sheets are actually other than the people that got hammered because of COVID, the rest of the country's balance sheets are even better. We'll talk about this theme for a couple minutes. There are two economies right now, not one. We are living in a country where there are simultaneously two separate economies. And it's really driving people crazy, but it's actually a big part of what's thematically working in investment markets. Companies, especially large companies, can very easily get financing, and important earnings in technology and healthcare and places like that are exceptional. They're not just okay, they're excellent. Again, the media is only going to kind of give you part of this story, right? Financial journalism wants to get you to watch by sort of scaring you.
Well, who wants to hear about a certain company reaching their earnings estimate, right? I mean, that's not very exciting. I do think, Kurt, that this probably explains the political mess that we're in right now. Is this tale of the two economies that you talked about on that fourth bullet point, right? Because, and I'm sure you'll get into this, but like the divide in terms of those that are suffering greatly versus the rest of the population that has actually improved their balance sheet is creating even more polarization in our political environment as well, I think.
Yeah, and honestly, the separation in economic classes has widened tremendously in the last several years. And part of the debate that a lot of us are having is there's not much you can do about it in the short term. In order to save the COVID destruction, you had to inject the economy with a lot of liquidity, and that benefited also the people that needed it the least. We can't sugarcoat it. It's not political. It's just math. And it's part of what we're going to face in the future is unwinding that. We're trying to figure out a way to help the 21 million people that were unemployed in April and May. That number is dramatically lower now, but there are still a lot of people that are in need. And it's very difficult to find pointed ways to help those groups of people. And so far, we didn't do a very good job of focusing it. We handled it with a blunt instrument.
And that's one of the questions, by the way, in the chat that just came through, which is, do you foresee that huge debt that has been taken on from PPP and bailouts, and how that affects inflation in the future? So maybe, of course, table that until you're ready, because
we'll talk about that. Yeah, I've got a couple of slides here to show. Things we're worried about, hospitalizations, of course. I mean, it just spiraling everywhere around the world. It's and we're all learning how to deal with this thing. But the last thing anybody wants to see is another round of truly having to shut down large parts of the global economy. Permanent unemployment, there's some jobs that aren't coming back. This is going to be a problem. We can't continue to pay 6 million people to sit at home on their couch. This is a major dilemma. This is Washington's biggest dilemma right here. And they seem relatively clueless about how to handle it. Tax rates, of course, is going to be an issue, especially with a regime change in DC. Commercial real estate thematically is a problem because we're all learning, you and me as well, Zacc. I was skeptical at the beginning of this, and my teams here have done an amazing job working from home. Incredible. And so as we grow, I need less office space, right? We're going to talk about this for a minute. This is a real issue. Companies that are the walking dead, they should be bankrupt. So should we just jump in and highlight a few of these things?
You go for it. Exactly. Yeah, let's do it.
And some I'm going to skip over. This simply shows all of Bank of America's credit cards and debit cards. Spending has normalized in this country and normalized very, very quickly. These are actual orders in hand, manufacturing orders in this country. You can't fake it. You can't make up the data. We are back at the all-time highs. The reason this kind of data I'm going to show you is because it can't be manipulated. You can't fake strength in an economy. There is genuine ordering and genuine demand, and it's coming from a lot of places. So these are the types of things we have to look at under the hood to find out how real the economic bounce is, or if it's kind of built on air. This is China's PMI. Okay, this is the largest exporter in the world. China is really the epicenter of funding retail demand, right, around the world. And their PMIs are reaching back towards record highs.
Hey, Kurt,
Okay,
a
this
lot of
is
people, a lot of us people think that PMI stands for private mortgage insurance, in our day-to-day lives. And so isn't it producer manufacturing index?
it is
Okay.
it is it is
So just for everybody here listening, when Kurt says PMI, what he's talking about is how the businesses and the entities that are producing things and actually manufacturing things, they have an index to track how much output they do each year. And so China is saying, he's saying that China's PMI, or how much their manufacturing, is following that trend,
yeah.
not mortgage insurance.
Good catch. Good
Right.
catch. This is insane. This line is showing what it would cost you to secure the lease of one container out of the Shanghai port to ship something to the United States.
Oh gosh.
I mean, again, data that you can't fake. This is not somebody's spin. Try and get yourself a container, right? I mean, it's okay. You don't see that in recessions. That is not a recessionary piece of data, right? Even the earnings surprises. Okay, to be clear, there are two issues. Earnings are down from when we went into COVID. If you look at the whole S&P 500, okay, we have had a contraction in net earnings in this country. That's not what this chart shows. This chart shows, based on all the estimates of what the companies would make, what was the actual in comparison. And in the history of the data being recorded, we've never had so many surprises to the upside as we saw coming into the fall in 2020. So in other words, analysts got too negative in the summer on what earnings were actually going to be, and they've had to quickly move those back up. Saying it another way, it didn't get it nearly as bad with earnings damage in this country as we feared when COVID started.
Yeah, let's not pretend that analysts were the only one thinking that that the market was gonna stay down, and that
Oh yeah,
companies were not. You know what I mean? I was
yeah,
feeling that way. I'm thinking, oh, we could be quarters and quarters, if not couple years, before some of these companies, climb their way back out of this. And then we're seeing earnings turning around really quickly. So this is also something I think that most individual investors are not thinking about, which is earnings are actually doing quite well, or at least they've surprised on the positive side. And you
mhm.
mentioned that overall earnings are a little lower, but I think that it is surprising to many people to think about the fact that many of these companies either have recovered or are at the same earnings level, or they're pretty close and they've made a lot of money back throughout
Oh
this
yeah.
whole time.
And many important companies, Zach, are making a lot more money than 1 year ago.
Right.
And something that's important to remember, and I think you and I talked about this on a call last year. When you look at the S&P 500, you're thinking about the 500 biggest companies in the United States that are publicly traded. Okay, but there's something that is misunderstood about this. Okay, the problem with this is 50% of the S&P 500 index is technology and healthcare. Okay, this is why the S&P is not a great barometer of broad health in the US economy, because the entire energy sector, how important is energy to the world, right? I mean, it's incredibly important to our daily lives. It's only 3% of the S&P 500,
Right.
right? So a lot of the really most hard hit COVID sectors, travel, energy, et cetera, they just aren't a big part of the S&P 500. And that's what's deceiving sort of about the data.
Well,
So,
not only that, I mean, you probably, of course, you follow this very closely, but for the listener, not only is it concentrated into technology and healthcare, but then if you take the top 5, 10 names within the S&P 500, the biggest stocks out there, then those make up a massive percentage of the S&P 500 as well. So it's not just in tech, but in Facebook, Google,
yep,
Apple, Microsoft.
yep,
Netflix was in there for a while, but anyway, it's extremely concentrated in few businesses. That's something for people to realize, that they don't just take 500 stocks and say, we're going to say give each equal weights and see how the market does. It's
right,
cap weighted. So those big
right.
companies are driving the price of the S&P a lot.
There was a time 100 years ago-ish that the Dow Jones Industrial Average was 40% railroads. There was a time that railroad was technology, right? I mean, we don't think of it that way, but railroads were technology then. Cars were technology then, right? This is why it's organic. It's moving all of the time, right? I mean, there was a time where a fax machine or a Xerox copier was high technology. And so it's always evolving. And right now, Google, Facebook, Amazon, etc., they are by far the biggest expanders of the US and global economy. And it's not even close. And that's why they get such a big weight in the market, This is really, we are at a 60-year low of available homes to buy. 60 years.
My sister's feeling this right now. She is feeling this. She has a kid, a dog, and a kid on the way, and they are having the hardest time finding a place to buy. It's tough.
Yeah. And especially at any kind of reasonable price point in a lot of places in this country, it's become nearly impossible. And by the way, there's no signs of this changing in the short term, because we went through months and months of very limited construction. And so you have people simultaneously, I can get a 2.79% 30-year mortgage. That's free money. I can get, I got to get out of San Francisco. I don't want to live here anymore. I want to live out in the suburb, right? You have a lot of factors that have come together at the same time. I'm going to show you something here. Okay, I'm hearing a lot, Zacc, about bubbles. Bubble is people's favorite word ever since .com and '08. Okay, it's way overused. Just because the value of an asset goes up doesn't mean it's in a bubble. Okay, this is a really important chart when you hear somebody say we are in a real estate bubble, and this is why. If you go back to the formation of the housing crisis, okay, you're going to notice that a really meaningful percentage of the mortgages being issued were to the lowest FICO scores in the country. It was big. A lot of the mortgage paper being issued was to people without good credit. Look at what is happening. Look at who is buying real estate. Look at this. It's all the highest credit scores, right? You're seeing almost zero movement in the subprime market, right? So I have other data, and I didn't want to put it all in here, but the average size of a down payment as a percentage of the mortgage has never been higher. These are cash-rich, high credit quality buyers in real estate right now, okay? Now, I'm not saying real estate's not overvalued. That's all in the eye of the beholder. But what I am saying is we're not reliving '08. It's a very, very different foundation to where the mortgage market's being placed right now.
So you're saying we're not reliving '08 because the people who are buying are different buyers in the sense that in '08, it was that bottom credit score that was able to actually buy homes they should not have been able to buy. Is that
That's
what
right.
we're saying here?
That's right.
Well, and
And
the
you
other thing that's
look how active the highest credit scores have been.
Right. And the other thing that I'm finding is, if you look at the price of lumber that has tripled, quadrupled, depending on what time period you're looking at, that puts pressure. I know a lot of folks that are just not building because the cost of lumber got too expensive about 5 months ago. So that shrinks the supply of existing homes as well because fewer people are building new just because of lumber costs.
Yeah.
Yeah.
And again, this is not a commentary on if it's overvalued or undervalued or whatever it is, but it's important to understand what the fundamentals are. The quality of the economy is what I care about, Okay, this is probably the most important thing I'd like to emphasize on our call today, but also in all of my meetings with my clients right now in thinking about what's coming over the next 1, 2, 3 years, okay? We have seen something happen that is actually pretty rare historically. We went through a multi-decade trend of savings rates moving lower in this country. People used more debt and saved less cash, okay? We all know that. We expanded the amount of debt being used. Then '08 happened, okay? And we never quite got back down to where we were. We kind of found a floor around there. Look at this. This is an unmatched reading in the history of the US data.
And
Okay.
Kurt, real quick, but so that people can digest this, let's maybe explain what we're looking at here. This
Yeah.
is the percentage of someone's income that they're putting away in savings versus just spending or borrowing and accumulating more assets or just spending on travel or whatever it may be. But we went from, it looks like, in the 12 to 13% range back in the 70s, and
Yeah.
gradually from 1970 to 2005 went down, and so that people were no longer saving 12 to 13% of their income, they were saving 2 to 3% of their income. And
Yeah.
then 2008 and 2001 and 2008 basically scared everybody so much that they started saving, 10 to 12, and then came back down, hit a floor of about 7. So 7 was like the regular savings rate for almost a decade.
Yeah.
And
And,
and then
and,
here,
and
go ahead.
And when you think about it, interest rates peaked in the teens back here in the early 80s, right? So interest rates made a multi-decade trend lower as well. So it's not surprising that people saved less and used debt. They borrowed instead of just using cash because borrowing got so cheap. Not surprising data whatsoever. What is surprising was when COVID hit, as a country, we went full blown emotional panic mode.
Mm.
As a group, we put more cash on the sidelines and into bank accounts as a percentage of our economy, as a percentage of our income, and it's not even close. You can look at the World War II data, the World War I data, it's not even close. And so what we're left with is we're left with $7 to $8 trillion that is now sitting inside of checking accounts, that's here on the left, and money market accounts here on the right. Okay. This is the highest form of liquidity in our country. And you can see where we were, and then what happened as we got into COVID. There was an absolute race to stockpile cash away. And what it does is that is always really a direct indicator of our fear level. We're going to immediately spend less money. We're going to reach to sell things we don't love. We're going to try and get our balance sheets back into a really rock solid position. And that's what happened. Okay, why am I emphasizing this so much? That amount, 7 to 8 trillion as a percentage of our economy, is massive. That is an incredible amount of cash to just be sitting in money markets accounts and checking accounts. And what has happened historically, this is '08. So we go into the financial crisis, and you can see money market funds here in the blue, and the same phenomenon. People get scared and they put mud cash away. They save, right? They get nervous and don't spend money. But what happens always afterwards? That money bleeds back into risk assets. People get more comfortable, more confident, they calm down. Okay, maybe I can make an investment in a business, maybe I can buy a rental property, maybe I can, spend a little bit. I need to upgrade my car. It's got 300,000 miles on it, whatever, right? That is what lays the foundation for the next bull market. We have a problem, a great problem, but we have a problem. We have a massive amount of cash now, and it needs a home. So where is that money going to go? If bond interest rates are near 1%, who wants to buy government bonds? Okay, so the most asked question I've gotten over the past 3 months is, what do I do with my money? Because we manage a lot of money for high net worth families. High net worth families in this country, Morgan Stanley just put out their poll last week, UBS had one about 2 months ago, have never held as much cash as they're holding right now. And it's not even close. Okay, so now my phone's ringing and we're saying, what do we do with the money? So if you want a short answer why the stock market is so strong, it's because people aren't thinking about today. They're thinking, I've got lots of cash. I don't know what to do with it. I know eventually earnings are going to be a lot better in this country. Let's buy some stocks now. I'll put them away, knowing they're a little expensive right now. And Zacc, truly, stocks are a little expensive right now.
They are. They're above average. And that's
Yep.
something that I think people should understand as well, is that when you look at valuations of what a stock is worth based on its earnings growth, its dividend rate, there are so many ways you can factor and come to a calculation of what a stock should be worth per share. And no matter how you slice and dice that, it's not cheap right now. You're not looking at things that are on sale. And if they are on sale, they're probably on sale for a reason, because there's a problem in the business. And so if you want to buy high quality businesses, you kind of have to pay up at this moment. It's almost like the labor market. If it's, in certain times, if you want a really good employee, you have to pay them a little bit more. It's a very similar concept here that we're dealing with stocks. But Kurt, how do you foresee? I mean, the money's not likely to go to bonds. I mean, they basically just keep it in the money market anyway if they're going to earn bonds. So
Yep.
I guess my question for you is, do you foresee that this massive and record level of money in money markets and checking accounts, that it will actually flow into equity markets? Or do you think that people will wait on the sideline longer? What are your thoughts here?
I think it's actually a little of both. I think that you're always going to see now, with the baby boomer generation moving more into retirement, I think you're going to see higher cash levels for a very long time now. I think that's just one thing that's sort of a given. But secondly, I look at my own situation. I'm holding more cash than I've held in the past. And with the understanding that I know it won't make any return for me. It's just going to sit there. It's an insurance policy. My cost is that it's not making anything. That's my cost. But it's an insurance policy. And what's I think will happen is we will have to be comfortable with a barbell approach. You might hold a little bit more cash than you normally would, because why buy bonds if they're not yielding you anything anyways, right? I mean, why take any risk if you're getting almost no return on them, right? So but at the same time, I allow myself to own high growth companies also, even though they're not cheap. And the understanding is, and the reason I emphasize it, is you have to be ready for one of two things. Either more volatility, because we have a market that's pricing itself for perfection. So if something bad happens that we don't see coming, the market could have a lot of volatility, like it did with Corona. We dropped 34% in 3 weeks in March, right? Okay, that's a lot of volatility. But the other thing is the market could go sideways for 2 years, and that could happen very easily while earnings catch up to the stock prices themselves. But you can't overthink it and try to jump in and out, because with the amount of liquidity in the system, the market could go up another 80% before it goes sideways. So if you get too cute, you really could get left behind. So you have to be willing to sort of bifurcate your approach to this, and maybe hold both a little more expensive assets than you would normally hold, and maybe a little more cash than you would normally hold at the same time, as almost a hedge. I don't know if that helps, Zacc, but that.
No, it does. And it does. And I think to your point, you and I probably are biased towards the idea of, we really like owning stocks, and we do own bonds in these portfolios for clients. So there's a reason for bonds in portfolios as well. Even though we're like, why own bonds? I think what we're really talking about is, why own long-term bonds, right? Because it's still worth, especially if you have money sitting on the sideline in cash, we can allocate that to short to midterm bonds inside these portfolios, minimal volatility risk, and a little bit more interest than what they're going to get on cash. So that's why in IRAs and 401ks and regular accounts, we do throw some bonds in these portfolios. But I think, let's just clarify, we're talking about they should be short to midterm to reduce that risk. It used to be that people would buy 10, 20, 30-year bonds that earned 7, 8, 9, 10% coupon rates or interest payments, right? And they call it clip those coupons, and they just got that interest, and those days are gone. So that's why we don't extend out that far. So maybe a takeaway from this is I like that concept. And as investors think about the barbell approach, right, of taking, there's this middle ground of kind of mid to long-term bonds. They used to be less risky than stocks, but probably not anymore. And so it's worth maybe owning stocks and going shorter term with your fixed income portfolio.
I'm glad you clarified that, because I own bonds and I want most of my clients to own bonds. I'm talking about overweight. Where are you going to add more than where you would normally have it? I've actually added a little bit more to things like emerging markets and small and mid caps, which are not cheap, but that's the only place in the world that's growing, truly growing fast, right?
Right.
But you're right. The bonds that you've got to have a place in your portfolio for dampening volatility. You got to have a rainy day allocation and things like that. Yeah, it's good clarification.
So maybe a couple questions here, Kurt, because we really don't have any super specific agenda other than get people
Yeah.
information they want, right? So let's just see what we can do on some of these. There was one question about, do you think that a big factor in larger personal savings is a significant reflection of people not taking big expensive vacations? I'm going to take a quick stab at this, and I would love your opinion. While like the anecdotal evidence of my conversations with my clients would make me think the answer to this is absolutely, because all my clients are like, I would have spent $10,000 more this year if I could have gone on this cruise, or if I could have gone to Europe, or whatever. Um, while that's true at that micro, like personal finance level, I think that the magnitude of $7 to $8 trillion is of a whole different reason, and it's more emotional, and it's more being fearful, and what Kurt's talking about, from an investment decision and insurance against possible risk. These types of massive dollar amounts, it's institutions that are pushing that much cash, probably more so than individuals. Don't you think?
Yeah, there's the S&P 500 company cash levels right there. To your point, yeah,
There you go.
you've seen it across the board. It's a. By the way, that point is true. The average household has more cash because they have spent less, including vacation. Like that's
Right. That's part of
absolutely
it.
a great point. The other thing, by the way, is that we didn't really talk about yet is we overstimulated the unemployed. In other words, with the $600 extra per week in unemployment benefits, in April, that meant that 75% of unemployed people were making more than they were making in February. So we were basically paying people to stay at home. So all that's true. Some of that cash is actually these weird asterisk issues because of COVID. But you're right. The lion's share is still these massive institutional allocations to just sitting and waiting. And we see it a lot with our high net worth families.
Yeah, for sure. For sure. Okay. So then I'm going to keep going on some of these other questions. So maybe tackle, I'm trying to keep topics. One of them, by the way, is a conversion of traditional IRA to Roth. That one's outside of market considerations. That's a tax planning issue. I'll tackle that really quick, and then we could talk about that whenever. Just call us, call your advisor, or talk to me. But the main point is, you're going to pay about the same, or have the same net effect, if the tax rate is at the beginning and the end the same, whether you do a traditional or a Roth. The point is there a better tax rate now or a better tax rate later? That's the bottom line in that decision. But we actually have calculators to run that, and that's a more of a personal finance question, for a one-on-one call with you. Hey, what about precious metals? That was one of the questions, Kurt. What do you think? Opinion on investing in precious metals?
Yeah, and I think there's a category of assets that are very unique. Precious metals, obviously gold being one of the most popular conversations in there. It's not too far of a conversation, a way to extend this to cryptocurrency and Bitcoin and things like that. Um, I am not a huge fan of non-producing assets. Like traditionally, I want to own something that's producing something, like a corporation or something like that, right? Where 1+1 = 3. All that being said, I own some. I own a little crypto, I own a little gold, I own a little, I think it can make a lot of sense. And a lot of those are sort of my hedges against Armageddon. Just like, we spent less on vacations. My wife spent more on food storage. I go into my basement. I'm like, where did I get all this stuff? Like, I'm ready for Armageddon. I'm ready for the zombie apocalypse at my house now. So I think some of these things are a great hedge. I wouldn't make them a huge part of your portfolio. One thing that's really interesting, if you study, we actually wrote a white paper on this here inside the firm. We have an analyst that did a big thing on this. If you go back and look at the last 6 or 7 inflationary periods in the United States, the most consistent winners were farmland and stocks are the most consistent, best hedges to inflation. So if you're owning those types of assets for an inflation hedge, believe it or not, corporations are a great hedge. How much has that stupid iPhone gone up in price in just the past decade? I mean,
Right.
things that we bought.
$99 to $1,200,
Oh,
roughly.
I mean, like these companies, they pass it on to us, man. They're not eating the inflation; they're giving it to us, and
Well, I
so
think of Visa. I think of Visa and MasterCard as great inflation examples, right?
right,
Because I think of shoes and running shoes that used to cost $25, and you go to like a legitimate running store and buy a decent pair of running shoes, you're talking 125, 150. My
yep,
daughter is deep into soccer. When I played soccer, we bought cleats for $80 to $100, which seemed insane. And I walked in there, and the top cleats are $300 a pair, and so of course we go to the clearance rack, and I'm like, you can do it when you're paying for 'em yourself. But anyway, the point is the Visa card was swiped in all those transactions.
right.
So
And
they
they
don't
get
care.
2% of all of it, right? I
Exactly.
mean, it's just the more the better. Yeah,
Right. So there's an
yep,
inflationary. So that's one of the reasons stocks can work so well.
yep,
So in a to wrap up that precious metals, I would say that's a good thought to have within the portfolio. I have seen many people when gold hit 1,800 an ounce and went down, almost cut in half, like within a year or two. This was maybe almost a decade ago. Lose a lot of money in something they thought was super safe. So you want to size the bet right and not go over.
yeah.
Um, let's see. So I want to make sure
And
we
by the way,
tackle.
let me say one thing on Bitcoin so we can close that off because
That's a
it's
good
been on a
idea.
lot of people's mind. Is that I crypto development in our opinion is very much like internet in the 90s. You know it's going to be important. You know the technology is exceptional. It's really hard to understand long term who the real winners are going to be. And so we kind of encourage a basket approach and not making it too big a part of your portfolio. That's kind of like our counsel. And it's not because we don't like crypto, it's we don't know. It's early. We're on the bleeding edge of this thing still.
Right. Okay. So I'm getting quite a few interest rate questions actually,
Yeah.
and I think it's worth talking about this because I feel like we as wealth managers talk a lot about interest rates, but we don't make the connection for clients so they can understand what that means for them personally within their portfolio. And
And I can see the questions too. Robert asks a question. That question that Robert asks is exceptional. And Robert's question for everybody who can't see it is that, when we talk about low rates, are they independent of all these market issues? And how much is the Fed basically manipulating rates? And how much is the stock market being manipulated by the rates? In other words, there's like this domino effect, right? Zacc, you want to take that one or you want me to take it or what?
I'll give the basic answer and then you fill in all the details. So interest rates are a function of what happens in the economy because of course we talked about it earlier when it feels like you're borrowing money for free. Like let me give you a quick example. If I am running a business and I sell shoes and if I can borrow $1 million at something incredibly low, single digit low interest rates, and I can then turn around and get a different retail stores set up, employees, and that's what I'm going to use that money for. And all of a sudden, I cash flow out of that from the sales of the shoes, enough money to cover that interest. And then and then I rinse and repeat that, right? So now I'm running a profitable business. If I fast forward 5 to 10 years from now, I could, with inflation, shoes going up in value, we've talked about it already, like I kind of don't even care about that mortgage or that payment. It's a lot like my current mortgage on my house. I felt like it was really big when I first got it. And I'll just explain. I mean, my mortgage payment on this house I live in was $1,700, and I thought that was insane. I thought I was getting taken to the cleaners over that. And then you live in it a decade, and you realize that people in your neighborhood have maybe three and a half, $3,500 payments for the same house that you do in your neighborhood. It starts to not matter as much. So interest rates, I said, that's the basic premise of how these low interest rates help businesses realize that, hey, we can make a lot of money and expand really easily. But Kurt, maybe take that deeper for us and help us understand how that impacts today's markets as well.
Yep. And then Roger had a follow-on question about inflation. How does this interest rate environment and the money printing affect this on the back of that? What Robert's asking about, this connection, it's really interesting. That to a certain extent, the Fed can only control interest rates in one degree. The open market is also a control mechanism. So there are actually times where the Fed's trying to get rates to go up and the market continues to buy bonds and push rates down. sometimes the open market is in disagreement with the Fed, right? So as most of you probably know, the way that the Fed does it first is they say, we're going to go into the market with the primary dealer banks and we're going to loan them money at this, right? And they set at a rate that Federal Open Market Committee board governors set, and they loan money to these banks at a half a point or a point or whatever it is. That's where it starts. And when you hear about the prime rate, all that's happening is the banks are getting money from the Fed at this rate, turning around, marking it up a little bit and giving it to you at a prime rate. Okay, that's where rates start. Okay, but now the bonds are out in the open market trading. And what will you pay for a bond? And the higher you're willing to pay for safety, the lower interest rates go. Because you might pay a premium to buy a bond, a government bond, because you're reaching for safety, right? So why in these big recessions and scares like in COVID, those treasury bonds went up and up and up and up in price because people from all around the world were buying US government bonds to hide for safety, out of fear. And that made rates go lower and lower and lower. It wasn't the Fed saying we have to make rates lower, although the Fed wanted rates lower. It was the market actually pushing them. So at any given time, what you'll notice in the bond market is either the Fed's doing one thing and the market's doing another. They're usually together, but sometimes they're separate. And so this question that Robert's asking about, is in order to get easy money out into the system during COVID, the Fed, there's a lot of conspiracy theories about how the Fed's trying to control the stock market or whatever. They have no way of controlling the market other than this. I can put a lot of money out into the system for cheap. So what that does, to Zacc's point, is it lets companies survive. If you are a company on the edge of disaster and you can go to the bond market and raise $40 million to save your business for cheap, you win. We just staved off thousands of bankruptcies in 2020 because rates were so low. It worked. But there's all kinds of domino effects from that. And one of the domino effects is now there's cheap cash sloshing all over the system. I'll give you an example. Right in the middle of all this, Google, $100 billion in cash. Over the summer, Google had in the bank, $100 billion in cash. They don't know what to do with it. Google has $100 billion in cash. They don't know what to do. And then I wake up one morning and Google is issuing $10 billion in bonds. Why on earth is a company with $100 billion already in cash selling another $10 billion in bonds out into the open market for people like us to buy? And do you know what the interest rate was? 0.45%.
It's just like, why not? Why not do it now? That opportunity is not going to be around for forever.
You got it.
And they're thinking, we'll take 110 and we'll pay 0.4% on that 10, and that's nothing to them.
That's right. Are you telling, Zacc said this earlier, are you telling me that the executives at Google can't find something to do with $10 billion for 5 years at less than a half a point?
Yeah, if they can't turn around to do a return on that money of 8, 9, 10%, I mean, then they're not running the business properly, right? So they turn around, earn at least 8, 9, 10%, probably more, pay a half a percent away, and they're really happy. Shareholders are happy with them. Hey, real quick, a couple questions on interest rates, because as we run out of time here, I want to make sure that we cover this, because really what we need to talk about too is how do people move forward with this? There was one question from Roger, which was, how long do interest rates stay down, or how long do we expect? I'm just going to quickly say the Fed has signaled that they will stay down until things improve overall in the economy, and it's going to be a while. Like, obviously markets are up, but they say we expect it to be a while. They've been very conservative and telegraphing quite a bit of it. Now, of course, Roger, all those things could change really quickly, right?
Well, and one thing on that, Zacc, just last week, the Fed vice chair said, I've never heard the Fed be this specific. He, at a press conference, he said, we will raise rates when inflation is up 2% for a year.
Right.
I mean, it doesn't get more specific than that.
Super clear, right?
There's your answer. And by the way, inflation's coming. It's not today's business. It's eventually coming. And the bottom line is this: can the politicians later start taking the punch bowl away when we don't need it anymore. And that's where things are going to get really interesting.
That is tough. Hey, this one question we have about it's a lump sum pension question. If I have a lump sum, should I wait to invest it, basically? But I
Yeah.
think that's the right question for everyone to be thinking about as well. Maybe just not a pension, but I mean, if you have money, it's invested or not invested. How do you foresee that? Like, what should an investor do with cash right now, or with money? Give your thoughts in general, kind of as we wrap up and think about. We've given a broad market view of current conditions.
Yeah.
How does someone look forward?
Yeah. And we have a lot of clients that, get lump sums of cash. Usually they've sold a business. Like one of our clients, they'll sell a business, they got X amount of money, and now this is their net worth and they're older. And now what do I do with this? They're scared out of their mind. It's great to have that money, but this is everything I made my whole life. Now what do I do with it? My simple rule of thumb, Zacc, is this. It, if it's uncomfortable to invest all that money at once in a lump sum, my general rule of thought is immediately invest 1/3 of what you have, maybe one half, a third to a half, immediately invest it. Okay. Because now it's like when I went to the floor, I was a floor trader in New York early in my career. And my mentor used to always say, when in doubt, sell half and hope you're wrong. That was what he always taught me. In this case, buy half and hope you're wrong. Maybe the market will go down lower, you can buy more cheaper, and then in time, you'll end up making a lot more money. But I like to stage the way I'm doing investments. You don't have to be in a hurry. You can take your time, but be methodical and have a plan in advance. Don't let the emotional tail wag the dog like Zacc was talking about earlier. It can be pretty nasty. We have a lot of clients, they buy X amount every month, every quarter, every year, whatever. And so, and on a lump sum issue, you're usually specifically saying, what's the annuitized rate that I'm going to get paid on this lump sum issue, right? And in this environment, it's almost always better to take your lump sum and invest it on your own, because most of the counterparties are not going to give you a very good annual interest rate on some annuitized type of investment. But you got to run the numbers.
You got it. And we actually have a calculator for that. And I think this decision has already been made for this person. I know him lump sum, but I think you're thinking, should I wait? And I think that's great advice. It's called dollar cost averaging. I do like around that half range as well. A lot of people, the math says that if you invest it all, that most of the time you're better off. Like,
Yep.
this is an emotional thing. The true hard math says invest it all, because most of the time you'll lose out by not investing it all. But for a lot of people, it's okay. Losing out on a little bit of growth to have a better sleep, at night,
Yep.
Matt, is okay, right?
Yep.
So as
Yep.
we wrap up, Kurt, what would you, a short little summary here at the end, what would you tell investors, all those on the call, about what to expect here moving forward in terms of markets and capital markets or economies, or anything that you feel like is the most, let's put it this way, what are you watching the most looking forward?
Yeah, I think the real issue is all this cash that's on the sidelines. Cash and interest rates are a big deal. It needs a home. There's a major tailwind. It doesn't pay to outthink what's going on. It's easy to get too cute. I am bullish about what's going on, because at the household level, and we have a lot of slides we didn't get into here, but the average household is in excellent condition. Balance sheets look good. A lot of cash in the system. Rates are very low. And here's the thing: both parties of government don't want to screw everybody in the country, right? The Trump administration, no Democratic groups ever printed as much as that Republican administration printed, right? So the signal is, we are going to print money. We're going to make liquidity available. And those are not times that you want to be betting against capital markets, is when there's a war chest of cash sitting on the sidelines that needs a home when rates are zero, right? So I try not to overthink this, like not to get too cute with this. The trick becomes, you got to own best of breed companies. Be careful. Know what you own. There's a lot of bond funds out there that have garbage in them. They're companies that should be bankrupt already, but because of the easy, cheap money, they stay in business. So the one giant caveat, Zacc, and you and I talk about this all the time: know what you own. Own high quality businesses. That's probably, those two issues are probably my biggest kind of things on my mind right now going forward.
Perfect. Hey, thanks, Kurt, for joining today. Tell us about the slides. I usually get a couple questions about, hey, can people see this? I mean, obviously they can see the recording.
Yeah,
I don't know if those slides are available for distribution.
they
You'll have to
are.
maybe let me know.
Absolutely. I'll
Okay.
send them to you right now. Yep, you can send them
Okay.
out.
Usually people ask, so we'll send over, and there were, I know from I looked over the deck, and the way Kurt does this is he constantly is updating an ongoing, here's what's happening in the economy deck. So I think it has about 50 slides or something
Yeah,
like
yeah,
that,
yeah.
which there's no way we were going to get through all that today. But
No.
I do think we hit some really important topics. It seems like we focused a lot on interest rates based on some of the questions and government spending, but I think it's been wonderful. Thank you again, Kurt, for spending some time with us.
Hey, it's always fun being with you. I hope everybody's doing okay, is safe and happy, and has a great year.
Thank you very much.